from the sidelines of Morgan Stanley India conference, we are joined by Chetan Iyer, the Chief Asia Economist of Morgan Stanley and our favorite economist on the street as well. Chetan, good to see you today. Hope you're having a great conference out there. Before we talk about Asia, I just want to set the context for the world as well. A lot of data points coming in out of the US. Now, fewer number of people are believing or expecting many rate hikes this year, but now the can has been kicked for 25. What are your thoughts on the health of the US economy right now? The street may want actual rate cuts, but the real world wants growth not to stall big time in US. How are indicators looking in your view?
So we are very constructive on the US economic outlook. There are two things that are going well for the US. Number one is that there has been a strong Capex cycle that is underway. To give you an example of that data point, US non-residential Capex is currently growing at about 5.2% real. And that is extremely strong considering that overall real GDP growth is somewhere around 2.5% to 3% on a year-on-year basis. And number two is that there has been a big pickup in the immigration inflows, and that's providing the support to the labor market. There has been a positive labor supply shock. So from a Fed's policy decision-making perspective, you've got a bigger economy in the US, but not necessarily tighter economy. And so we think that the dynamic in the US is evolving in a way that growth will continue to be healthy. And as far as the inflation outlook is concerned, because of this positive labor supply shock, we've seen a steady deceleration in wage growth that we think will eventually bring down inflation to a level where Fed can begin cutting interest rates. And more specifically on that inflation outlook and the Fed policy outlook, we are expecting that the next 3 months inflation prints will be 0.2% month on month, high annualized rate of 2.4%. And that would give the Fed the comfort to cut interest rates from the September policy meeting itself.
That's interesting to note. Let's shift focus and come back to Asia. The second biggest engine right now in Asia and globally, of course, after US is China. And though the inflation numbers are coming lower, the concern on growth out there stalling in a very severe fashion. PMI data seem to be indicating that. What are your thoughts on the China growth and China inflation, because that will have a cascading effect on the entire commodity sphere as well, which the world and India consumes a lot?
Yeah, so I think the narrative that we have for China is that it's seeing cyclical stabilization, but the structural challenges are still persisting. Now, on a cyclical basis, there are two things that have helped China's growth situation. Number one is that there has been a pickup in global trade cycle, and that has helped improve everybody's exports in the region, but specifically China has also seen the benefit of that. And number two is that they have actually pushed in more investment in the manufacturing sector. So they're trying to manage and support that real GDP growth with increased investment in the manufacturing sector. So that's helped them to keep GDP growth in the range of 4.5% to 5% on a real basis. But the challenge we feel is that the structural issue of slowdown in demand because of property sector is still exerting deflationary pressures. And in that environment, as they are trying to support real growth with more manufacturing investments, it's resulting into excess capacities and continuing to have that inflation in a weaker trajectory. So, yeah, I think from a structural perspective, the issue that we were most concerned about is this debt deflation loop risks. Those risks are still pretty much alive in China.
Right. Chetan, let's come back to India. And I remember in our previous interaction, you had indicated that India and Indonesia could actually start or kickstart the rate cutting cycle in India whenever it happens. Why don't you revisit that to us and the way data points have kind of come out between our last two interactions? How does it appear from here on?
So we have a few weeks back taken out our rate cut expectations for India. And the basis for that is that we think that credit growth is running at a pretty healthy and strong run rate. At that rate of credit growth, the leverage pickup in the system is quite meaningful. So it will be difficult for RBI to encourage further acceleration of credit growth by cutting interest rates. At the same time, the deposit growth is much lower compared to credit growth. And as you saw in the last monetary policy, the RBI had kind of given a soft guidance to the banks that they need to kind of try and fix and bridge the gap between credit growth and deposit growth. So again, in that context, if they cut interest rates, it will encourage banks to cut deposit rates, which will take them further away from that bridging of gap between credit growth and deposit growth. And then the other aspect that we were thinking about is the trajectory of inflation. So to the extent to which we think inflation will go down to 4.5%, but not necessarily 4% and sustainably stay there, it will also be difficult for RBI to cut interest rates because of that reason.
Chetan, but we have just started monsoon here in India. If it indeed comes out as a normal monsoon, the full season, do you see that will also have calming effect in parts of the inflation and hence things could be under control?
It should definitely help the food inflation outlook, and food inflation, as you know, has been the key reason why inflation is above 4% for the central bank. So it will help. Having said that, the challenge for food inflation is that we could get volatility in one or the other segment. Right now it's onion prices and then some other segment. So I think to the extent to which volatility in food inflation has been persistent for a number of years, it is difficult for us to build food inflation going down meaningfully, like going down to 4% and staying there for a longer period. And hence we are still building in no rate cuts from the central bank.
Chetan, let's shift focus and talk about something which has been top of the mind for entire nation, and that is elections. But more important from the macroeconomic point of view, the composition of the government which is happening, touted as a growth oriented government this time round, but the way it has come in coalition this time, it has sparked worries in certain sections of the market that the government may though continue on the growth focus, but also try to blend in redistributing capital and resources. Now they have ample of them towards the bottom of the pyramid. How justified is that concern?
So we think that, look, if you first of all analyze the past elections outcomes and the government policies towards redistribution or investment, it is very clear to us that the past data for the bottom 20% of the population in terms of their real income growth tells you that the periods in which the government actually kept revenue deficit high, i.e. that they kept the redistribution related spending much high, they encountered this dynamic where real income growth for the bottom 20% was not great. And that resulted into incumbents losing in the general elections post that time period. So first of all, there is no evidence in the data that tells you that the excessive focus on redistribution gives you the right political outcomes. And then the second thing is that if you were to even assume for a moment that the newly elected government takes a message out of elections outcome that they do need to spend a lot more towards redistribution, the point that I still question is that why would you do that from year one? Even if you want to do redistribution spending, it'll have to be in the last 18 months, because I don't think that this government doesn't understand that if they do take up too much redistribution spending, it will bring inflation. And as I was explaining earlier, if inflation is there, then the real incomes for even the bottom 20% will not be great, and that will also backfire. So considering all these aspects, we think that the government will stick to its plan of continuing with supply side reforms, trying to achieve moderate to high GDP growth, but at the same time keeping inflation in that low to moderate run rate level. It will be good for the economy, but more importantly, it will be good for the bottom 20%, and therefore it will not affect their elections outcome adversely.
Fair point, very valid point. In fact, good economics in this way can turn out to be good politics as well. But if they don't do it, then bad economics can worsen the politics. And for every UP, there's a Madhya Pradesh as well. So that argument is also something. Let's move on, and I want to understand. Yesterday, Finance Minister took charge. Fiscal deficit containing that and keeping it under check has been one of the biggest achievements so far, and it appears that it will remain. Though the 100-day agenda of most ministries are still not out in detail, but do you expect reform momentum to continue? Now they have extra buffer as well after that big dividend transfer from RBI. In the run-up to the budget, what are your thoughts around that on the reforms front?
So I think the most important policy change that has taken place since 2019 is this whole push towards investment-driven growth. And attended to that, all the policy changes that they have taken up can be summarized in one line, that it is implementation of supply-side reforms. And that policy, we think, will continue. All what we may see is some different packaging of the policy changes that may come up in the budget, where they will have to do a little bit more marketing, if you were to say, to ensure that that budget is being perceived as if they are also taking care of the bottom 20% immediately with some specific policy actions. But I think the overall path of fiscal consolidation will be maintained. Overall direction of implementing supply-side reforms to boost investment will be maintained.
Point. I mean, they would. You feel that continuity on investment-led growth, and then some mild kind of a messaging that nobody is left behind may actually be the order of the day. I want to talk about growth, India growth. We've seen World Bank raise it. We've seen the previous interaction from the RBI raise estimates, and we've had a very good 8.2 under the belt. On a more prolonged basis, if I do take 2 to 3 year kind of a view, where do you see the trend growth happen in these circumstances for India?
So in the next 12 months, we think that 6.5% to 7% growth is likely. And then beyond that, we are at 6.5% on a real basis going forward. And that is up to 2030. So we think that, the way you think about India's story now is that it's going to compound on a high GDP base at that moderately high run rate. And that's going to ensure that India's GDP is rising up to about 8 trillion by 2032. So we've got a strong growth forecast continuing into future. I know that some of the investor community as well as market participants think that you could achieve higher growth rates than that, and 6.5% is less compared to what China had achieved. But I think that this number of 6.5% is still going to be very strong. And the key dynamic that I mentioned earlier, that you are going to have this investment push and investment-driven growth rates, that is going to ensure that the productivity environment is well kept and well maintained. That will keep the macro stability indicators in check. So if you look at the previous cycle that India itself had seen this investment-driven growth, that was 2003 to 7. And in that period, even while GDP growth averaged 8%, you had inflation around 5%, and you had current account deficit below 2%, all the way right until 2008, when oil prices had gone to $150. That's when there was a small breach above 2% on current account deficit. But essentially, the moot point is that this 6.5% GDP growth that we are expecting will be in an environment where macro stability indicators will be in control, and that's always great for investors in terms of the returns.
Right. Outstanding, Chetan. That's an amazing point which you made. Moderately high, which is 6.5, but durable between now and 2030 is actually no less feat. So we should not get hung up on the high GDP growth number, but look at the circumstances and rising trend as well. That's a very beautiful point which you made. Thank you very much, Chetan, interacting with us from the sidelines of the India conference today, and have a great conference. Great to have you as always.
If you like this video, then like, share and subscribe to ET Now.